Welcome to Building Wealthy Habits. This is a podcast where we talk about financial items each week. Today, we have a super exciting episode. We're talking about real estate. And real estate is something that so many of our clients either already hold or we encourage them to hold. And for this conversation, we brought in an industry colleague. We brought in Josh Coniglio, and he is a financial advisor. He is the director of financial planning at Pacific Capital. They're here in Southern California. We work with them a lot. We really respect what they do. Pacific Capital, I think, is a little unique in the sense that their clients, the ones that they focus on, are 10 million plus of kind of investable assets, and usually people who are entrepreneurs, serial entrepreneurs who have maybe had one or two exits. And I anticipate the conversation of real estate comes up all the time. So Josh, welcome to the podcast. We're excited to have you here. We're excited to have this conversation.
Yeah, thank you so much for having me. Appreciate it.
Yeah. So kind of to, I guess, kick us off a little bit and get going, we like real estate. It's not something that we directly manage, but we, similar to you guys, we're fiduciary planners in our role, that we're looking for what makes the sense for our client holistically, not just what we manage, but what is building the future that they're excited about. So I guess, Josh, I'll just start with you. I mean, when you come in and see people having real estate, what are some of the things you say, wow, that's such a great use of real estate? What are some of the best uses that you see on a regular basis?
Yeah. Most of our clients have some piece of real estate in their portfolio. We love real estate. We think it's a great diversifier. It's a great asset class. A lot of people think it's the end all be all, and all they do is real estate, right? Especially those who've had some success in real estate, they tend to stick with that. But really, few purposes for real estate, right? There's cash flow purposes. Real estate's a really powerful tool in building equity and then being able to use that leverage for other things. So I think everyone's portfolio, regardless of net worth, should have a little piece of real estate in it, because it's such a powerful asset class for most.
Yeah, that's good.
And just a definition, but I mean, real estate, obviously your home and residence. We're talking about invested real estate outside of that, and of course, there's a wide variety of types, right, of real estate. And what would you say the most the success? Or I mean, where would you pinpoint what kind or what type of real estate would you really kind of focus on as far as your research and your studies for the client?
Yeah, good question. I think it really depends on the client's plan and what kind of involvement that they want. We've seen a lot of success in commercial real estate as well as residential real estate and multifamily specifically. Again, I think it depends on what the client's objectives are, whether it's cash flow focused or equity building focused, and also what level of involvement they want, right? If you're managing tenants day to day, it can get exhausting and maybe you don't have time for that. So I think which direction they go kind of depends on what they're looking for. But yeah, we've seen success kind of across the board and all different kinds.
It's interesting, your comment earlier about people who, in other words, I have clients who they've always been real estate oriented. That's what they did. They bought and sold real estate. So for them to diversify away from that, it's almost like peeling away the scab on a sore. They just don't get it. And it takes a great deal of persuasion to say, no, you're too concentrated in one thing. And particularly if they're all in Southern California, it's like, come on here, let's get diversified here a little bit. And do you have that same issue sometimes when you're with people like that?
Oh yeah. I mean, people love real estate because it's such a tangible asset and they can go look at it. They can, it's there. It's something that they own physically. And that's a big deal for a lot of people. And to your point, people who've made money in real estate want to duplicate that over and over. And I think what we as fiduciaries try to show them is that, yeah, there is a place for real estate in your portfolio, but we need to consider liquidity and things like that because a lot of real estate is typically pretty illiquid. And so we meet a lot of people who have giant net worths, who have great cash flow, but they're not super liquid. And so just showing them kind of on a pie chart, how much of your net worth is in real estate versus liquid assets versus cash, that type of thing. We focus on that and make sure that, hey, we're not telling you to sell all your real estate, right? We love real estate. You should keep it, but we should look at diversifying out of it if that's all you have.
Yeah, and that's a great comment. You're saying whether real estate is an investment or what are the other purposes of it? Like I've seen a lot of clients, especially business owners, who over time they buy their building, whether it's a warehouse, whether it's an industrial type building, and it's a great purpose. And the attorney side, we'll talk about this later. The structuring, like we'll set up an LLC, and we'll do things like that to keep them separate for a myriad of reasons. But sometimes owning the building is a way for them to build wealth, beyond just running their own business. There's other folks who that's like an operational need for it, like they're using the building. And there's others who have it entirely a separate and it's simply an investment. And for them, they're looking to build. And I think your comment about liquidity is so vital, because when it's your own building, you don't care as much about liquidity. You care about, you're saving yourself the rent you would be paying to somebody else. You're reinvesting that. You're paying off the mortgage. Like there's all sorts of great things you're building. But the idea of liquidity is usually less on their mind. Whereas when you have an actual just straight investment, I just want to get this in the market and let it grow. A lot of that stuff, if you need the money, in 3 months even, you probably can't get to it yet unless you had to fire sale the building. Usually you need a year of planning before that to be able to liquidate that on a tax efficient basis. So that comment of liquidity, I think, is so vital. I think people who love real estate sometimes miss that. I had a client recently who was very, like you said, large balance sheet, lots of assets, but was struggling each month to feel like, how am I even doing this? And we just had a good conversation of saying, you have so much tied up in real estate, and the real estate that some of it he wasn't using, it was just vacant land that he maybe wanted to use in the future. And then it became a real good moment to say, hey, let's liquidate some of this stuff to give that liquidity. I'm going to pivot just a little bit. When does real estate not make sense? I mean, where are some times, Randy or Josh, where you've seen it come through and you're like, ooh, this is just not fitting with where you're trying to get to and what you're trying to accomplish. We need to either not go into real estate or really even separate from some real estate that you have. What are some examples of real estate is not the best idea?
Yeah, we see it a lot where people want to invest into real estate just for potential tax benefits. And that always raises a red flag for us. And in that, the tax benefits of real estate are great. It's a very tax advantaged asset class, but anytime you're making an investment for the tax reason, it's usually not a great thing, right? We want to evaluate the investment as an investment. And if there's an additional tax bonus, that's great. But a lot of times people will say, well, I need to buy a real bunch of real estate, and they're overpaying for that real estate, or maybe the cap rates aren't great, the area is not great, but they're just trying to buy things quickly. I think that's one of the things that we see, that real estate might not be the greatest. Yeah. I don't know. Randy, what are your thoughts?
Again, I'm older than both of you, probably not I wouldn't say combined, but pretty close. But in the early 80s, when I started out in the business, the late 70s, early 80s, highly large deductible plans came out. So clients could buy into these partnerships and get, for every dollar they put in, they could get multiple write-offs, 2, 3, 4, 5, in some cases 5. But the Mission Inn is a prime example. It was structured as a historical property with major write-off. It failed miserably because in 1986, during the Reagan administration, they passed this law that says you can't pass all those write-offs if you're a passive investor. You have to be actively involved in order to get those write-offs. It destroyed the vast majority of those programs. And what I'm always concerned about is tax advantages, because the government can shift on you really fast. And they can move and they can change the tax laws. In real estate, going back, Josh, to your comment, it's time oriented. You don't buy real estate and sell it next year. It's something that is going to be taken for a long time. And you have to be really, I guess, cautious, I guess is what I'm saying. You don't want to load things up and all of a sudden the laws change on you. And it just becomes this huge, the backpedaling. You're trying to figure out what to do with it. And it's not an easy asset to handle, right?
Yeah, to your point, we see it too, where folks will try to jump into something too much too soon. A novice real estate investor will want to take on a multifamily unit, and if they have vacancies, they don't have the personal cash flow to cover that loan, right? That's a pretty big red flag.
Or the management skills, right?
Yeah, exactly.
Management skills are a big deal, and real estate is a very I want to say labor intensive, but management intensive, particularly if you have multiple units. It's one thing if it's your business that you paid for and then you sold the actual business, but you kept the building. It's a little bit different animal. But just to buy out a piece of real estate, everybody's selling it for a reason and everybody's buying it for a reason. You better be really clear why you're buying it.
Yep. The other reason I think that real estate, adding onto those, often doesn't, at times cannot make sense, is when people see the quick flip, like the market's going up, it's just going to keep going up. So like you said, Josh, rather than considering I just need a tax write-off and they're making a poor choice, I think people who are becoming so into the good choice, I got to buy now, I'm going to hold it for 6 months and flip it, it'll all be leveraged and I'm going to make double my money in 6 months, when they're so rosy on the market. And that's happened. People have jumped in real estate, they've leveraged themselves, they've made really good money, but the risk level on that is quite different than people putting, their assets in, say, a diversified stock portfolio. The ability to go to zero, or the ability to really take a big haircut. So I think when we have, people that come in that are so excited about real estate, not just in this is going to be good for my portfolio, but to say we have to do it now. We have to do it now. Clean out my 401k. I want to, and they have all these ideas that they've read online, or there's some great websites out there for people who are building wealth through real estate. Some really good ones that you can go on. But there's also people on those forums that have just ridiculous ideas. This is how you need to finance things. This is how leveraged you should be. And so we always circle back to the planning idea to say, hey, where are you trying to get to? What's your plan need to build? And as we have a plan developed, where does real estate fit? And often it fits a couple of really good places, but there's a few moments where it doesn't fit great. And the other thing I liked, and we can shift a little bit to kind of the structuring of the nuts and bolts a little bit. Randy, you mentioned the laws changing. A lot of our listeners, we've talked about, 1031 exchanges, which is a tax code where you can take one piece of real estate and instead of selling it and paying your taxes, you actually roll over to a new property and kind of keep that same tax base. Well, laws used to, right now you can do that with real estate. You can also do it with other things. You used to be able to do that with stocks. Years ago, you could exchange of your stocks from one to the other. And I'm not sure the era when that changed, that personal property being able to change that. But man, I imagine, the week before that changed, people were, rolling their Apple basis into a different, whatever stocks were around then, Boeing over to Microsoft, that they were rolling these stocks and really enjoyed that process, delaying a lot of these gains. But then the law changed, right? And that because it became different. So real estate still has the ability to roll from one asset to another. And that makes a huge amount of sense for a lot of our clients. But like you said, Randy, the laws change. I guess to Josh, maybe a question to you or to Randy, like, are there things where you've seen, hey, this was a good idea initially? Like, we were glad you're in real estate, you're glad you're doing this, but then either their life changes or the rules change. I guess any examples of times where real estate, it then became something they either should hold more of or should hold less of just because things have changed compared to where they used to.
Yeah, I think about, when we think about tax planning around real estate and how sometimes there's a way to accelerate depreciation on your real estate, and it's, cost segregation study, it's out there and it's a very powerful tool. And what we always, and it sounds great on paper and it looks good, but what we always remind the client is that when you do that to a property, you are marrying that property for the long term, right? Because you're taking all of that depreciation up front. And if you sell it, you have to recapture it and we'll pay tax on it. Now, this is where the 1031 comes into play, but I've seen people invest into shorter term real estate deals, do a cost seg, accelerate the depreciation, and then realize, oh, this investment was not great. I got a great tax benefit, but the investment itself wasn't great. And then they want to get out of it. So then they got to roll all this depreciation to another property, and then you're kind of stuck.
I mean, it's interesting to me how many real estate people, when we talk about, to realize the depreciation that they've taken, when there's a recapture of that depreciation, even people in the real estate business don't know that. I mean, it's surprising to me the number of people I've talked to that actually have cut their teeth, they've made their living. But when it comes to the recapture of depreciation on a property, it's like they're like, don't understand. Like, what is that about? And I'm sure you've run across that, Josh, and it's like, whoa, this is a wake-up call, right?
Oh, yeah. Yeah, we've seen it done on a big scale. And we counsel our clients on every nook and cranny of that because we don't want them to have that surprise, but it happens all the time. If real estate people are great, if they don't do their due diligence, they can advise people in the wrong direction. And then you get a massive tax bill. It can be crippling for sure.
Yeah. And as an advisor, I mean, it's a big miss. It's just a big mess. If you're not talking to the clients about this, say, do you realize this? I mean, they understand appreciation. They understand capital gains. If I buy it for 100 and I sell it for 200, they kind of got that structured in their head. But I said, if you held the property for 15 years, I can go back on the tax return. I'm sure, Jeremiah and Josh, you can do the same thing. Go back and we can see how much depreciation they've gathered every single year. And they go, oh, I didn't know what that number is about. And it's just, you analyze it and say, well, you've taken it for 10 years. If you sell that property, you now have to pay ordinary income tax on this money. And they go, well, that's not fair. I said, yeah. talk to the IRS. I don't know, but it's the way it is, right? It's the law of the land.
Yeah, that's good. That's good. Well, we talked about a little bit of structuring. Let's pivot there a little bit of A lot of people, when they buy real estate, initially they say, I'll just buy it in my own name, right? I'm just going to buy real estate. My name's on my house, things like that. That's, in my mind, level one. You own it. But that's the only benefit. The next, often people will talk about having LLCs, having trusts, having, limited partnerships if they're doing an investment, kind of moving up the ladder of complexity. There's even folks who will bring these, they're called Delaware trusts. They'll bring in these other ideas, say, hey, I'm going to invest in this separately. Josh, when you talk with clients, where are you pointing people when they're thinking about real estate? What are you kind of, assuming pointing to their attorney partly, but also I'm sure you have great ideas to say, hey, this is what we think would make sense for you to kind of structure your life. How are the things usually structured for you guys?
Yeah. So as a general rule of thumb, we love LLCs, and we love every property to have its own LLC. That's in a perfect world, right? It can become a lot of work if you do that, but at least setting up LLCs to own one or two properties is, I think, baseline. And I think clients often get confused or turned away from that because they say, well, I have this liability umbrella policy that covers it. And I think beyond just the liability protection, the LLC, in my opinion, offers cleanliness of accounting. Mm-hmm. I meet so many people who have investment real estate, and I tell them, how's your business? And they, well, I don't have a business. I just have real estate. I said, time out. That's a real business, and you should treat it that way. Having that LLC, I think, keeps everything in its own box. It allows you to treat it like a business because you have your revenues, you have your expenses, and you have your profits. And so we recommend that. And then if you go a step further, right, having a trust have ownership in each of those LLCs. As much as you can separate yourself personally from your business, I think is the best situation.
That's great. I love in that comment, the clarity of accounting, like even it's just a mental shift, right? To treat it as, I've seen a number of people who are cheating on the balance sheet or cheating on the profit and loss statement, that they're putting all the expenses over here, but the revenue here, and saying, look, it's great. And then when you really dive into it, you realize you actually spend a lot to either repair it or to manage it.
We often recommend clients set up a separate bank account for each LLC, right? You want one bank that gets the rent checks. You want one bank that's paying the mortgage. Maybe you have like an umbrella LLC that owns those, right? But having each property or set of properties have its own accounting will save you a lot of time and headaches, and probably your accountant will be happy with you as well.
Yeah, that's right.
So when do you recommend going into a partnership or going into some organization that buys the real estate and your client now is a limited partner or some minority holder in that situation? I mean, the due diligence process can be brutal.
Yeah, that's a great question. We have a lot of clients who participate in that, and our team does a lot of due diligence. Frankly, we get pitched on this stuff a lot.
I'll bet.
And so there's challenges to it, right? That asset class is great because it doesn't require a lot of participation, right? You just kind of throw your money at it and hope that it does well, which there are some great groups out there that do a good job. There are also some not so great groups where there's layers and layers of fees, where distributions aren't always sent. So it depends on the investor's appetite for that. Like if it's a really busy entrepreneur who doesn't want to go and look at properties and buy them and just wants exposure to that, that's a great fit, right? If we could find a great company that fees aren't crazy, the management structure is very clear. But again, I think it's just based on what the investor's appetite for that is.
And how do you sort out the good guys from the bad guys? I mean, that's really a hard one, right?
Yeah, it is. We get on the call with the team directly. They send us a slide deck, we get their diligence room, and then we ask to speak with them. And we ask them questions about some of their other funds in the past, how those have done, how their track record's been, what their debt structure is like. So we really want to pop the hood and talk to these people about their offering before we can make a recommendation to the client. Right? The last thing we want to do is tell a client, yeah, this looks great, and then it doesn't do well. And that could still be a possibility even after our due diligence, but at least we've looked under the hood and at least taken a look at what their books are like.
Do you grade it? How do you come back to the client and say, this is a 1 to 10, we think this is a 7, or no, these people, no, I think it's a 5. I mean, no, this is A+. I mean, is there a way that you indicate to the client, because you can't give a sterling recommendation to anybody or everybody that comes in.
Yeah.
Right.
Yeah. I think we build it based on the client's goals, right? So one group or fund may be great for one client. That's a 10 out of 10 recommendation that may not be a fit for this client, right? Maybe we have an older client who wants exposure to this, but we know that this fund is a 10-year hold. Probably not a great fit, but that 10-year hold fund, if everything else checks out, could be an A plus for the 35-year-old investor, right? So it depends on liquidity, it depends on fee structure, track record, what else they have in their portfolio, and kind of what their plans for the future are, I think.
Yeah, that's great. And even just to give a quick plug for Pacific Capital, I mean, part of what you guys do is not just, hey, let's think about this, but you guys jump right in. I mean, we were talking with some of your clients that your clients get pitched all the time. Like, here's an idea. I have a buddy who wants me to do this. And what a benefit, I think, to your clients when they can flip it over to you guys and you guys run through the numbers, you run through the details, you run through the planning, and then you hop on the phone and you call them and you say, well, we're going to interview these other folks, get to see if this is legit. I mean, I think that's such a huge benefit. And the clientele that you guys serve, they're going to be presented opportunities all the time, right? And so for you guys to be the ones not just to look at it from the outside, but to jump in, get your hands dirty, and then be able to come back to your client and say, hey, we've spent this many hours looking at what this is. We think it's a great fit for you, or hey, this is one to take a pass on, and then to be able to say yes, no, and then move on. I mean, I think it's phenomenal that you guys do that, and I think there's a lot of folks out there who, if they're not working with you, wish they had someone like that in their corner. Not just to tell them, hey, go buy more stocks, but to say, I'm going to get my hands dirty, understand this for you so that you have a resource. Like you said, busy entrepreneurs, right? Busy entrepreneurs who are doing big things. Man, I think they need you in your corner. We were talking this the other day about what you guys do on that private placement as well as the real estate. I think it's so valuable for your guys' clients that they have a team and a resource that is really protecting them. I think of all the big investors, the Bezos and Tim Cooks, even LeBron James, right? Like, they're not searching this stuff out themselves. They have a team, and you are that team for a lot of folks. So yeah, you guys do so great in this area, I think.
Yeah, thank you. It's been great. We really want to be that kind of that backstop. To your point, many of our clients have had successful business exits, and once that happens, word gets around, and a lot of people come out and want to pitch you their new business idea or their new fund. And a lot of those are really great, and some maybe not so much. But yeah, we want to be that resource where the client can say, awesome, excited about it, but go ahead and talk to my team. And that's where we step in. We just make an objective recommendation on it. If it's good, we will 100% say yes to it. We also look at how much of their portfolio is allocated to that type of thing. Again, this goes back to liquidity and diversification, right? If the client's becoming super illiquid because they're doing too much real estate or they're doing too much private equity, we want to communicate with that to them and say, hey, we're a little heavy here. We should probably maintain liquidity on this side. And that can be a big challenge for entrepreneurs because they've gotten wealthy and had success because they do jump at opportunity.
Yeah, they limit their diversification. They increase their risk, and they made it, right? So they're saying, this worked for me. But it's different when you're trying to take the profit and you're investing that money for the future. And it's different than when you're in the business itself and you're sleeping on the floor under your desk while you're building it, right?
Yeah. Well, even keeping that dry powder, I think that's a big piece too. Like, people who jump at every opportunity because, hey, I've got the money. It seems like a good option. And even if it's not one swinging for the fences, it might be 20 different good ideas. But then the number 25 comes up, and that's a phenomenal idea. But now they're tied up in other stuff. I think that's part of it too, of saying, what does this fit, and keeping that dry powder. I had a client years ago who, on the legal side, helped him sell off his business. All these resources, but it was just so apparent in that moment he was going to start another business, different industry, different. Like, he was just that type of person. And so we told him, like, you need to keep some of this money dry, this dry powder, that it's for you to build your next thing. And I think it was really good advice to him because personality wise, he started a company with his son. They started doing like an off-road racing company, and it wasn't just a hobby for him, just his mindset. It became a business. They were bringing in other people to sell the product. I think that's so great when people can really, especially an advisor, can advise that to say, you're not the type of person who's just going to throw this in the market and sit back. Like, you need to use this money for something new, and to allocate some of that appropriate amount. To say, this money can be at risk. This money is your dry powder to really build something new. I think that's so good. Last kind of topic on real estate is, if you're not just buying real estate, there's REITs out there. We talk about these limited partnerships where you're just an investor. Is that the same? Is it different? How do you view those versus buying a building or buying a rental? Is it the same thing, or is it just a different structure? How do you view that as far as the pooled real estate investing?
Yeah, I think it's completely different in that, again, it's based on your level of involvement that you want. Investing into a REIT is great. It's easy, doesn't require any involvement really. But there are challenges as well, right? There's a fee structure there that you have to really look into. There's a liquidity piece to it as well. On the limited partnership or private debt or that side of things, yeah, it really depends on what you're trying to do. I couldn't say one's better than the other. It's just how much involvement the client wants. What we've seen a lot of success in buy and hold real estate. So actually owning tangible property. And you don't have to do it all yourself, right? There's management companies out there you can hire. You'll have bookkeepers, all of that thing. But we've seen a lot of success in that. And so we kind of lean toward that. But, investor preference, I think.
Again, we talk to investors about not trying to time the market. I'm assuming the same thing happens with real estate. Obviously, historically, if we go back, 2009 would have been an absolutely perfect time to buy. But we're not going to have those events, every year or every 10 years. So when you analyze the timing, I'm assuming you have to analyze the cost benefit, whether you're going for appreciation or income or both. But timing's really important, I think, valuations, right?
Yeah. Yeah. I think it's impossible to time everything perfectly. I think what you look for is value, right? If fundamentally, if this property is if there's value in this purchase, maybe it's undervalued or maybe the cap rates are great. And value is also contingent on what interest rates are at, right? How much this property is going to cash flow based on the debt that you can secure. You kind of have to look at it from that side of things and see if it's a fit for your plan. But yeah, I mean, perfect situation. You buy every property you can in 2009 and probably right at the beginning of COVID too. So
yeah.
Well, right. If you were perfect, that means you would have sold everything you had in 2006, 2007, waited 24 months and bought. You would have bought 10 times more, right? I mean, we look back at that and we've had some clients. I'm sure you have too. Well, I did this and and I mean, okay, you were lucky.
Yeah.
All right. That's it. You were lucky.
Yeah.
The good crystal ball.
It wasn't a strategy. It was a luck.
That's good. That's good. Well, I think we've come to the end of our time. Thank you, Josh, for hanging out with us, for talking through this. If anybody's listening, has more questions about real estate, you can reach out to Tricord Advisors, reach out to Pacific Capital. I think specifically, if you're an entrepreneur and you had an exit, you have 10 million plus, and you're not sure what to do with it, Pacific Capital is a phenomenal resource, and I would encourage you to reach out to them. Thank you guys for listening. And until next week, we'll wait till then.
Thank you.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordadvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.